right, and welcome, friends, to this very special live video market commentary. My name is Jerry Robinson. We are followthemoney.com. Grateful to have you. We have a very large crowd tonight. As I would imagine, we've had a very interesting week, right? The last week has been very, very challenging for many people who have money in the market. And today we're going to be talking about some of those things, and I want to welcome everybody. And before we kick things off, I like to double check that we have a good connection so we don't spin our wheels too early here. So if you wouldn't mind just participating by going into your GoToWebinar interface there, if you see a chat or a question box, and just type a letter Y, letting me know that you can hear my voice and that you can see the screen. And I see many of you now chiming in. Thank you for that. I appreciate that. That helps me to know that someone is hearing me. I see many of you are here and you're present, but I want to make sure you can hear me. So thank you very much for that. Great to have everybody this evening. So yeah, let's go ahead and move right in. We have a lot to talk about. We just released our latest Robinson report. All of our members receive that every single Sunday evening. It is a big PDF report filled with lots of charts about what has been happening in the market for the last, several days over the past week. And then we also try to provide insights and commentary and ideas for the following week. At least they can be derived from that Robinson report. So we'll be pulling some of our information tonight from that latest report that was just put out for all of our members. And we are followthemoney.com. For those of you not familiar, our website is followthemoney.com. I encourage you to go check us out on the web. We've been around for 10 years, and we've been helping people just like you understand the markets, how to trade, how to invest, how to generate more income in your life. We also have something very special called the Christian Advisor Referral. And for those of you who are looking for sound advice when it comes to retirement advice, our CAR service is very powerful. Many of you in the audience tonight have actually used that free service that we provide. If you're looking for advice, and I tell you what, especially right now after we went through this big market correction, very fast correction that we're going to be talking about tonight. If you have all of your money in the market, of course, that can, that's what we call Maylocks money, right? Sometimes in moments like this, you really need to make sure that you're properly diversified and properly balanced. And if you don't have any money in a safe tank, so to speak, or if you don't have any money that's not subject to the whims of the market, then you really should talk to a trusted financial advisor. And one of our advisors is, to be perfect for you to speak to if you're looking for retirement advice. You can find more about that on followthemoney.com/advice. So tonight's agenda, what we're going to be talking about tonight is, first of all, what happened. We're going to look at some charts. We're going to talk about what has been going on in the stock market, and not just the stock market, but the commodities market as well. Gold, we saw also going down with equities. We also saw cryptos going down with equities as well. We'll talk about why these things happened last week. We'll also talk about why things could get better, maybe why things could get worse. We'll talk about some of those things, and we'll also talk about how to prepare. Now, quick disclaimer, this presentation is not a solicitation of any securities. Investing is risky. You can lose all of your money. I'm not a stockbroker. I'm not a financial advisor. I don't make recommendations. I'm only sharing investing and trading ideas for your information and education. You should always consult a trained financial advisor before making any financial decisions. So again, we've talked about what's ahead. Let's move right into what happened, because I want to talk about some of these charts that we have been seeing over the last several days. First of all, take a look at this. This is a big list of charts of the major market indices over the last 3 months. This is a 3-month daily chart, and you can see how the market was chugging higher. Here's the S&P 500 in December. Here it is in January, and then here's February. February is the month that we touched a brand new all-time high in the U.S. stock market and in many other markets as well. And then we hit the top, and the market just kind of cascaded down. We often hear that the markets take the stairs up and then they take the elevator down, and we certainly see that in each of these charts. You can see rapid declines in the Dow Jones Industrial Average, in the S&P 500, in the Nasdaq 100, in the Russell 2000, which is primarily small cap stocks, in the Nikkei, which is Japan's major index, the Euro Stoxx 50, which we track as well, seeing a huge amount of selling. The DAX, which is in Germany, also seeing a tremendous amount of selling. The VIX, really the only thing working on this list of charts here. As you can see, the VIX popping higher and setting some pretty interesting, really moving to an interesting high, which we'll look at in just a few minutes. Taking a look here at the 3-day hourly charts. Now, these are intraday charts. So they're not daily candles. They're actually intraday candles. But you go back and you look, this is for 3 days for each index. And you'll notice that as we went into the close on Friday, we started to see some of the markets kind of curl up. Right? And you're starting to maybe feel, if you've been paying attention to any of the news over the weekend, you're probably beginning to sense that we could see a burst of optimism or a burst or a rally at the market open. Looking at these charts, it's very possible that we will see a relief rally because we have seen so much pressure to the downside. And now we've had a little bit of kind of a timeout. The weekend has kind of provided us kind of a forced timeout. And now, of course, you may have some bargain hunters who are going to come out on Monday morning and try to bid this stock market higher. You also very likely, and as of the recording, we're doing this right now. Let me just double check to make sure we don't have anything from the Fed. As we came to the call, I did not see anything at all. But nonetheless, as we head into the new week, it's very likely that we'll see the Federal Reserve chime in. Now, they did speak over the weekend, or Jerome Powell spoke, I believe, on Friday, or issued a statement saying, of course, that they're always ready, standing by to keep the rally going, as they often say, to support the rally. But when you look here, you'll see that the market's very, very potential, I would say a strong potential that we'll see a relief rally this week, and it could be fast and furious, just like we experienced to the downside. And I want to temper that a little bit for some of you because although we could see a V formation, we could see the market really rally strong in the coming days. I want you to be very, very careful in that. Let me talk a little bit more about volatility here for a minute. This is an interesting chart, and you'll see that it goes back to the 2008 crash when we had this huge volatility peak. You see, this is a chart of volatility, this line, and you can see it going way up here to 60 way back in 2008. It went up actually a little bit higher than that. And we can actually see that this was almost just straight up shot for volatility. Now, this is the fear index. This is the index that rises. This is basically a basket of puts, mainly puts on the S&P 500. So when the market goes down, volatility is engineered and designed to go higher. And we see in 2008, we had this big financial crisis, and volatility just shot up dramatically. And then the Fed stepped in and started doing this historic intervention. And over time, we began to see other peaks in volatility, but you can see the one in 2000, which was also a fairly scary kind of sell-off. For those of you who remember the 2011 stock market sell-off, because the 2008 moment was so fresh in many people's minds, 2011 seemed like, we're getting ready to move right back into it again. But it was a fairly short-lived process because, again, the Fed stepped in with one of its numerous kinds of quantitative easing programs that it launched, Operation Twist, QE1, QE2, QE3, all of these different QE programs. And what they had been able to do is kind of engineer a decrease in the overall volatility. So you can see over time that we've been seeing lower volatility, each of the peaks getting a little lower. Here we had peak 3, which was the pre-election sell-off in 2015. Then we had the big historic Q4 2018 sell-off. You may remember that in December of 2018, there was a tremendous sell-off in the stock market, very fast, a very historic sell-off, one of the worst Q4s we had had in decades. And that was a lower peak. And so we had pointed this out to our members that we had been seeing this overall general lower highs being set since the 2008 peak. And that all changed in 2020. So we are in a new uncharted area here. This is peak number 5, and we don't know. We were calling it a peak. Of course, it could certainly go higher. But this is where it is now at 40, and we haven't been here for quite some time. So we have really moved back into a range where we're no longer setting those lower highs on the volatility index. And that means, my friends, that we have moved into we're certainly in uncharted waters, but we're also now in perhaps even a more dangerous place, because perhaps the Fed may or may not be able to control this. Obviously, the concern here is that what good is an interest rate cut against a virus, right? And this kind of pandemic that we could be facing. What good would the Fed be able to do by cutting interest rates? Interest rates are already at historic lows or artificial lows, right? Certainly, they've already pushed them down. They've already cut interest rates numerous times in the middle of a raging bull market. So in this environment, if they need to cut rates to be able to boost economic activity, well, they're already kind of up against the wall, and interest rates are already, well below 2%, and they don't have much wiggle room. We keep track, by the way, of the stock market with our market tracker trend alert system, and we've been doing this since 2007. Last Thursday, we picked up a brand new position downtrend in the S&P 500. You can learn more about our market tracker service. It's free. Go to followthemoney.com/market-tracker. You can maybe make that something that you bookmark. And every week we put new commentary on there. We refresh the charts, and you also get an opportunity to see the current trends on the S&P 500 as we, check them with our trend system. And the position trend went into a downtrend. Now, that's based upon the weekly chart. And then there's also a long-term trend, which is based upon the monthly chart. So right now, we still have the S&P 500 and the Dow, for that matter, and also the Nasdaq in long-term uptrends. But they're certainly, they certainly could break if we continue to see selling pressure in the week or weeks to come. But right now, the position or the weekly trend is now down. So position traders, be aware. Now, I will say this real quickly about the position trend being down, is that every single time that I can think, going back now for the last few years, every time we have had a position downtrend occur within our system, ironically, it's turned out to be a buy signal. And the reason is because the Fed will typically step in about that same moment and say, okay, well, we'll cut rates. And that, of course, creates the impetus, or it creates the catalyst for more buying. And so when we get a new position downtrend, which we don't get very often, I oftentimes get a bit more bullish because I know the Fed is probably just right around the corner, and they're likely to step in and say something bullish to try to stoke the animal spirits and keep things moving in an upward direction. Now, here's an S&P 500 chart that shows you the cascading sell-off that we just went through. You can see the position trend on the S&P 500 is down. The long-term trend's still intact. We lost the 200-day moving average on Thursday, and we sliced right through it. You see this rising volume here that we saw this overall sell-off on. Now we're back at just above the 2,800 support zone. This was the area that we were in back in October before the breakout that many of us have been able to ride right along that 14-day EMA, which has been really nice. Then we had 50-day support. So those of you who are platinum members in the audience tonight, you know that we have been out of our long exposure on like some of the things we do, like TQQQ, SPXL, those kinds of 3X longs. We got out of those, it wasn't last week, it was the week before. We closed out our positions and got short on a few different ETFs. We'll look at that in a few minutes. But, in this environment, as we head into a new week, we do well to ask ourselves, are we going to get a rally here? Are we going to see a V-shaped rally like we saw in the Q4 2018 sell-off? And then literally in Q1, we saw a massive V-shape rebound. Now, we'll talk about what could cause that tonight, how realistic that is, and how it may be more realistic that we're going to move into a very choppy area. You see, we've had a real nice run in the stock market since October, and this pullback is certainly not normal, at least the accelerating speed at which it occurred upon. So it's not a normal sell-off in any stretch of the imagination, but it is normal. It is true that it's normal to see a pullback in the middle of an uptrend. And so typically after a nice burst of buying, you will enter an area where you have to consolidate those gains. Well, this chart doesn't quite look like the typical chart that you would see where that happens. And typically after you have a sell-off of this magnitude, it takes some time to undo some of the technical damage that's been done on the chart. And so for this reason, it's very possible that we may see some choppiness here, and we may even see a rally that bursts higher as we move into the beginning of the week, only to be deflated later in the week, and that's due to a few factors we'll talk about later in the call. So the S&P 500 losing its 200-day moving average, 3,000 resistance zone here, that's a psychological area. So now that we're below it, breaking back above it could happen again on the first thing Monday morning. We may see that strength in the beginning, but watch the 3,000 area here and that 200-day moving average as well. That's going to be a key area next week that many people will be watching. If we break above it, watch for support at the 200-day and watch for support at that 3,000 zone. If we have a hard time breaking above the 3,000 zone initially, then watch that area throughout the week, because that could prove as further resistance and overhead resistance as we move forward. Really important too, because the S&P 500 is one of the key markets that we track, and you can see over here some of the ETFs that we use to track and trade the S&P 500. If you look at the S&P 500 index on a monthly chart and you put on a 36 simple day moving average, which is one that we like to use, you'll find that the big support range is right there again at that 2,800 level. This is the area we're closely watching on the S&P 500. If we violate 2,750 on the downside, then that's going to be pretty interesting. That's, in fact, going to be potentially problematic. And you can also see here that we have a very big candle. Some of our members, some of our students, you may know we've been talking about this lately. Watch for these big engulfing bearish candles to develop. And we have certainly got one. But the month, it obviously is officially over. And so this is the candle that we're left with. Typically, when you get a big, large candle like this, here's one also that you can see, it doesn't tend to just move back higher. When you get one of these, it takes a little bit. The market might stagger for a couple of weeks trying to figure out what's going on, or worse, it can continue accelerating to the downside. There's no reason necessarily why the markets have to move higher next week, aside from the fact that the market looks oversold. But the market can look oversold for a period of time, just like the market can appear overbought for a very long period of time. Everybody knows that. We've been living through an overbought market now for some time, and we know that it doesn't always accord with reason. So the same way here with this market, we may get oversold and may stay oversold for perhaps what may seem as an irrational long time, but it works inversely as well. So again, 2,750 to 2,800 on the S&P 500 index is the area we're watching. The Dow Jones also lost its 200-day moving average last week. It entered a new position downtrend. Again, this trying to find some support at around 25,000 on the daily chart here on Friday. Again, massive volume coming out of the Dow Jones, and here's some of the ETFs we like to use to trade the Dow Jones. If you take a look at a Dow Jones chart, you'll see we closed roughly where we were back in December of 2017. So this sell-off in an instant took us back to the December 2017 price levels. That's how stunningly quick a sell-off can be in the stock market. The Nasdaq 100 is also a very important index that we track and teach our students about. And as you can see here on Friday, we were able to hold the 200 days. So this is the unusual chart out of the bunch, the S&P and the Dow both slicing through that 200-day moving average support. But the Nasdaq trying to show some strength here. It fell an enormous amount from 9,700 all the way down to 8,100. That is incredible amount of sell-off here in just a handful of days. It's historic, quite frankly. I've traded my first stock in 1996. I have never, in all of my time, I traded through the dot-com bubble. I traded through the 2008 crash. I have to be honest with you, I've never seen anything like we saw last week. And interestingly enough, I didn't feel much fear throughout it because many of you who've been, learning under us for some time, we teach you about the importance of emotions and not allowing them to dictate how you are viewing the chart or any of that kind of thing. But this was almost to be expected. I mean, you could almost sense that this market was so elevated that we did need a pullback. And if it came underneath the excuse of coronavirus or whatever the excuse was, it seems like we needed this pullback. But the severity and the swiftness of the downtrend, of the sudden, quick sell-off, and the uncertainty and fear and doubt that surrounded it was something that I just have not seen, that I can't recall seeing in the span of a 5-day week. I mean, I remember some of the doldrums of the 2008 crash and even some of the height and the panic. But I still can't remember a week during that time that felt like what we sensed last week. Last week was different of some kind. We have entered uncharted territory with the Fed's intervention. They have pumped up this economy so greatly, and we have become so dependent upon over-leveraged debt. We have corporate debt levels through the window, or through the ceiling, I should say. We have interest rates artificially low. We have government debt that's outrageous. We have business debt that's through the roof. We have personal debt that's outrageous. I mean, this is a bad thing to happen right now when you have all of these other factors. And the fear, uncertainty, and doubt that lingers around the coronavirus we'll talk about in just a minute. Watch 200-day moving average support on the Nasdaq next week. We still hold our position uptrend on the Nasdaq, which is unbelievable after last week's sell-off, which shows you how elevated this market really was. It was so far up that it's going to take even more selling to move this into an official downtrend. That's just incredible. That shows you how strong this trend has been up to the upside. Looking at that same 36 SMA on the Nasdaq 100, about 7,000 is the area for trend support that we'd be watching. This is a really key area for the Nasdaq. We've had a really nice run, but that 36 MA on the monthly moving average, this is an area where we have found support consistently. Once in 2016, again in late 2018 when we had that big Q4 sell-off. So this is an area that, if it moves down to 7,000, that's going to be pretty darn bad, but that still happens to be the trend support. So that's the key area here that we have our eyes on. There are other support levels, obviously, 8,000 being one of them, especially between 7,800 and 8,000, that range, that window. But 7,000 is the key area for the overall trend support. Now, if we take a look at this very simple chart of the percent of S&P 500 stocks that are above their 200-day moving average, you'll find that we've dipped down to an area that's close to that 2018 low in December, which is around 25. That means that 26% of stocks in the S&P 500 are currently trading above their 200-day moving average. Now, an overwhelming majority of the stocks that are in the S&P 500 are already in a correction mode, which means they're down 10% from their highs. But you can see that the percent of S&P 500 stocks trading above their 200-day moving average is now about 26%, and that's pretty bearish. And again, we haven't been here for a while, but our members and our students know that we were just up in this area where we said it's time to take profits. It's amazing how this chart has worked over the years. And we like to pull this chart out whenever we get frothy and remind our students we are close. It's probably time to take some money off the table. And that came back in January. So once again, this simple chart in our Robinson report has correctly suggested that it was time to take profits. And now we're getting close to an area where we're probably going to see a rebound. We see something very similar with this particular market breadth indicator, the NYSE bullish percent index. which now shows that we are oversold in oversold territory, anything below 30. These are two that we've watched for some time, and they're both setting up and suggesting that a rebound may be close. We talked about the bond yields earlier. Bonds were among some of the only things that did well last week. A few currencies, the euro and the Japanese yen, were up last week. They actually served as havens. All of the different duration bonds, the 30-year, the 10-year, the 2-year, all of them rising last week. They served as safe havens. And a few other commodities like coffee. Coffee went up. But aside from those things, everything else was really down. And as you can see, the 30-year Treasury yield was down again to a new all-time low, breaking below this bearish channel that we had been in for some time. And we had actually held it in 2019, but we violated that low here. Now, yields begin to fall whenever people are concerned about the market and begin piling into bonds. And that's exactly what we see here. So we've seen this pullback. So here's U.S. bonds. Here's a 3-month daily chart. You'll see that every single one of these bonds, 30-year, 10-year, 5-year note, the 2-year note, all of them running higher. So serving as some sort of safe haven in this environment. Here's the 3-day hourly charts. They're still rising in this environment here. And the yields going down. When we turn to physical metals, this created somewhat of a question mark for some people. We did get a few questions from some of our students about why gold and not necessarily silver, because silver is an industrial metal. And so it does make sense that in a time of a global economic sell-off and fears of a global economic slowdown, you would get a decline in the price of silver. So that's not really quite a head scratcher. And nor is palladium, because palladium has been on fire for some time. It's up nearly 300% since we called a new uptrend in it back in 2016. It ran into resistance around the $2,800 area, and it's since pulled back. Not really a surprise that it's cooling off also, but gold had a little bit of a tough time last week, and I was able to get on the phone. My initial reaction was, this must be margin calls. And so I went ahead and picked up the phone and I called. I know several guys in the precious metals business. I made, probably was on the phone for about 3 or 4 hours, just talking to them, trying to hear what they're hearing from their wholesalers, trying to hear what they're hearing from their customers. Are their customers buying? Are their customers selling? And it turned out that several people told me that what they were seeing was some net selling directly due to the need to raise cash. Many people are over leveraged. And if you're not trading on margin, or if you don't trade with leverage, or have ever faced a margin call, then that may not make a lot of sense to you. But for those of you who know what that is, or those of you who use leverage in your trading or have ever had a margin call, that last week, that was going on quite a bit. And when you get a margin call, you have to get cash, and you've got it, or there's going to be trouble, right? You're going to have to liquidate what you've got, or you might even be in the hole. And so oftentimes in this kind of environment, you'll see everything sell off, and it doesn't make any sense. So people were selling gold last week. You think, why would you sell gold, whenever we have this potential pandemic, right? Well, a lot of it wasn't by choice. And note, the central banks were not the ones who were selling gold, right? These were people who needed to raise cash. So gold suffered last week, largely due, from everything that I can tell from all of my sources, was basically margin calls. Now, remember, in the 2008 crash, we saw something very similar to what we're seeing now, in the fact that gold began to go down with equities at the beginning of the 2008 crash. And that was also a head scratcher. But as soon as the Federal Reserve stepped in and began to open its mouth, gold began to rise. So what I would suggest to you is that we will probably see a little more softness in gold until the Fed really opens its mouth and says, okay, here's what we're going to do. And when the Fed, it suggests any kind of easy money policy, which we're likely going to get, because the Fed does everything in its power to stoke the wealth effect, to keep everybody feeling rich, so they'll keep spending. And they don't want the stock market to go down. Remember, 401k statements are going out. And people are going to open up their 401k statements. And the Feds, their goal is to make sure that you don't feel poor at the end of the month. They want you to open up the 401k statement. They want you to see that you either treaded water or you made money, and then you'll keep spending. But back in the 2008 crash, people would open up their 401ks, and it was that Maylocks moment. They said, what in the world happened to my account? Why have I lost so much money? And when that happens, people instinctively stop spending money, right? If you get a negative 401k statement where you've lost a lot of money, it tends to translate into maybe you don't eat out as much lately, or maybe you postpone that vacation, or maybe you don't go out and buy that extra car, or whatever the case might be. Some people react differently. And the Fed calls this a wealth effect. And so they continually try to stoke the market higher to keep people consuming, because the U.S. consumer drives the entire United States economy. And in many ways, it drives many other economies as well. Now, one of the reasons why this has become so problematic as of late is because the Chinese consumer is also very, very an integral part, I should say, of the global economy. And increasingly, U.S. businesses depend upon Chinese consumers. And so when we heard reports about the coronavirus and that many Chinese companies were seized up and they literally weren't opening, and entire cities were shut down, this was obviously problematic. And that not only hurts Chinese companies, but it also hurts U.S. suppliers to those Chinese companies. And it creates a lot of uncertainty. Okay, so you can see here that gold, silver, platinum, palladium, all kind of trying to form bottoms here. And we may see some renewed strength, or maybe even a rally in these metals in the week. You can see gold here. This is a big chart of PHYS, which is a gold ETF. It closed right around its 50-day moving average, which may actually serve as an area of support as we move into the new week. 1250, 1240 area on that is what we're looking at on this. The gold and silver ratio, by the way, soared to 95 to 1. It takes 95 ounces of silver to buy 1 ounce of gold. I mean, look at this ratio. You go back all the way to 2000, and it's just never been this high. It's just really getting off the charts. So silver and gold, the ratio is just very, very extreme. This is solidly in silver's favor. We fully expect as we move forward to see gold rise strongly. In fact, we recently mentioned on one of our podcasts, I believe, maybe it was a coaching call that we did privately, but I had mentioned that I envision gold hitting new all-time highs by over the next 12 months. We have everything in place. We have a 2020 election, which could create a lot of uncertainty. We have this coronavirus also, which is creating a lot of uncertainty. That's positive for gold. Silver also tends to move once gold really gets going. Silver will tend to follow, and oftentimes, usually, it'll outperform gold in the end, in the long run. But silver certainly very, very low relative right now to gold. Turning to Bitcoin for a minute, I know many of us are invested in cryptocurrencies, and I'm not going to talk about all of them tonight. I'm just going to look at a Bitcoin chart and just talk about this briefly. We recently touched a high of about 10,500, and I would suggest to you that some of the selling we saw in Bitcoin is similar to what we see in gold. That again, many people cashing out of their cryptos to raise cash for this event. I cannot overstress how much over leverage there is in this market. And often the retail investor may not participate in that kind of leverage. He may not fully understand that leverage, but that leverage is real and it's overwhelming. It's a tremendous amount of money that we have going on over leverage right now. And that means that when we have these quick, sharp pullbacks, it creates the automatic need to come up with cash to cover the leverage that you have. And so obviously Bitcoin would have been an easy thing to poach at that moment and take cash and go take care of what you have to take care of. Again, we also think with the halvening event coming up in May, I guess we're just about 3 months out now, or about 2.5 months away. We would expect Bitcoin probably to rise into that halvening event as we've seen it do before in the past. And we've seen to have some support here at the $8,000 to $8,500 range. I would be surprised if we saw it go too much lower. But again, if people need to raise cash, you could continue to see pressure upon Bitcoin. Overall, we're still in a long-term uptrend on Bitcoin. We're very positive about Bitcoin into the future, and some other cryptos as well. But we think overall, Bitcoin's long-term uptrend is probably going to stay intact and probably strengthen as we move into the remaining part of the year. And of course, that's total speculation. I have no crystal ball, but just based upon the charts, looking at what we can see, it seems likely that that's what we're going to see, support around 8,000. Okay, so we talked about what happened. Why did it happen? Well, there's two major reasons, and we talked about these in a recent podcast. Number one is the fear, uncertainty, and doubt over the global impact of this coronavirus that has investors spooked. So fear, uncertainty, and doubt. There is so much uncertainty right now over what this coronavirus is actually going to mean for so many different things. When we look at the number of cases right now, it's around 86,369. Now, these are confirmed cases. These are cases that have actually been confirmed. So we know that the majority of people who get flu-like symptoms usually don't go into the doctor, right? A, it costs too much, or B, you're like, well, I'll just deal with it or whatever. So the number of cases must be much, much higher. The number of real cases must be much, much higher, maybe even closer to 1 million, or maybe closer to 1 million. Who knows how many cases there really are. But these are the confirmed cases that actually exist, according to WHO and a couple of other different outfits. And these numbers obviously are probably not right. These are just numbers that are official numbers, and they're probably just best estimates. Coronavirus deaths, we've had 3,000. And so this is a tragic human toll that's happening here. Recovered 42,000. So the number of people recovering from the coronavirus is a pretty strong number. And in fact, the information that I've seen shows that the overall mortality rate for this COVID-19 is about 1%. It kills about 1% of the people that it infects. And that number can go up or down significantly based upon the age group. Like if you look at one recent study of 72,000 cases in China, they found a fatality rate of about 2.3% across all age groups, but then it rose to 8% for people in their 70s, and it rose to 15% for people above 80. So the elderly are particularly vulnerable to this kind of virus. And I think that's one of the things we have to keep in mind. There's 7 billion people on the planet, and many of them are older, and not all of them have, great immune systems. And so this kind of disease, if it spreads quickly and rapidly, that's why the world is rightly concerned about this possibly being a pandemic. Now, if we look at the countries with confirmed cases, we see the majority of them are in China, around 80,000 of these. Korea, about 3,700. Italy, about 1,100. There was some on this Diamond Princess cruise, about 700. Iran has about 600 cases. Japan, about 239, and on and on. You see, the United States has about 62 cases, right? These numbers are like nailing Jell-O to the wall, though. They keep changing, and they keep rising. I think the coronavirus is something that we have to keep in mind and put in context. When I think back over the several different similar types of threats that we've seen to the stock market, I think of SARS, I think of Ebola, I think of the bird flu, the swine flu, I think of all these different ones that we've seen in the past. And I think about how the memory of the United States investor works, where it's bad, and then it gets less bad, right? In other words, when it hits the investor's mind, when it hits the news channels, it's scary and it's bad. But then if we don't immediately see people around us falling dead, and if we don't immediately see the presence of this, then many times you have conspiracy theories that pop up. And other things is you'll have people who will just simply forget about it because something else happens. I don't know, Britney Spears releases a new CD or something, and the media says, oh, there's something else, here's a shiny new object, and they begin to focus upon something else. And Americans have short memories. And so how long this will be a thing to Americans is anybody's guess because America kind of picks and chooses what is problem. If you want to find terrible problems around the world, you can find many other issues besides the coronavirus. But this is the shiny new object that the United States is focused upon today. Are there other current and present threats to the United States? Yes. Are there ones that are even more pressing to the United States? Yes. But this is the one that is catching the world's attention right now. And it's obviously for a good reason. We don't want to see this spread. But at the same time, I want to keep your mind focused here that the United States has a pretty darn good track record of getting worried about these things. And then even though they don't change, they forget them and they move on to something else. So it's very possible that we see the market eventually just kind of try to forget this and we move on. Now, one of the reasons why that's going to be difficult is because we haven't had some of the quarterly reports come out yet from these companies saying what kind of impact this has had upon their company. Take a look at this. This was put out by the China Passenger Car Association. It shows that 92% of vehicle sales, or actually there was a 92% decline in vehicle sales in the first 16 days of February. This is because you have a lot of quarantine cities. People are not out shopping. They're not out going out and buying new vehicles. So for the first 2 weeks in China in February, vehicle sales plummeted by 92%. Is that going to show up in quarterly reports for auto parts suppliers? Is that going to show up for auto stocks? Right? Obviously, but that's just one little segment. That's one little industry among many industries that have been impacted by this virus. So it's shut down China. And China, of course, is slowly reopening, but the damage, has already been done. And now we have to hear the quarterly reports. The problem is that we are very likely to either overestimate the problem here or to underestimate it. So the reason why the stock market slipped so fast last week is something called price discovery. And what that means is that the market investors were trying to figure out, okay, the current price of the stock market is this, but it probably shouldn't be that because we don't know what these quarterly reports are going to say. We don't know how much companies are going to lose over this quarter. We don't know what it means. So we have to bring the price of the stock market down to discover the right price. And we don't know where the selling is going to stop. We don't know where investors are going to find consensus and say, okay, this is where the price should be now. And every day we're going to get new news that may adjust and cause that price discovery to continue. So we may have a lot of choppiness, is what I guess I'm trying to say to you, over the next several weeks. So it's the idea of a V-shaped formation here, of a automatic now rebound straight back up to the moon, back up to new all-time highs. Could it happen? Sure. Did it happen in December of 2018 and January after the sell-off? It did. It happened in early 2019, but will it happen again this time? It's very difficult to say, and there's still way too many questions and not enough answers to really see that being possible. So I would say if you pin me up against the wall and say, what's going to happen? I would have to say that I would either lean towards more selling until this kind of clears up, or a tremendously choppy environment over the next several weeks while the market tries to make sense of what's going on. So in other words, I'm not interested in this kind of market. I'm a trend trader. And so if we get a clear trend that's down and it really becomes material, that's something we can work with. But if this market is going to pop up and down, then you're dealing with a day trader's market. And that's fine if you're a day trader. It's great if you're a day trader. But if you're not a day trader, you're not a scalper, then in many cases, it's probably best to sit on your hands. That's what we're doing here. But we'll talk more about that in a minute. 68 S&P 500 companies have issued negative earnings guidance going into the next quarter. Microsoft is one of them. Apple is another. MasterCard is another. PayPal has also said that they expect negative, certainly they expect to see some slowdown in their next report. So we already have companies, but here's the reason why we don't have more, because many of them, they can't even tell you what they expect. They don't even know how to assess what's going on. So this is why it's so early and why it's a little concerning, is the fact that many of these companies, they haven't even quite come out and talked about coronavirus yet because they don't know how it's going to ultimately impact them. They know it is, but they don't have a number to give you. So therefore, investors are literally trying to figure out and discover price with very little data. And so when more data comes out, we're going to see much more, I would say, volatility as the price tries to be rediscovered. Okay, in addition to the coronavirus, we also have a contentious 2020 election. And one of the people that I've talked about recently is Senator Bernie Sanders. Now, Senator Bernie Sanders, it really spooks the rich, right? There's no doubt about it. I saw a recent headline from one old GOP radio commentator who I haven't seen in years in the news, but he was talking about how if Bernie Sanders is elected, that we will enter a new U.S. Holocaust, right? There will be a Holocaust in the United States. Okay. Well, this is the kind of language and rhetoric that tends to pick up around the 2020 election. And there's a lot of fear among the rich of Bernie Sanders because Bernie Sanders doesn't have any billionaires backing him. He's actually coming against the billionaires. Now, when you remember who owns the media, you remember that it's the rich. The rich own the media. And so the rich will tend to use the media to do what? To defend themselves, right? Of course, that's what they'll do. And so the rich tend to defend themselves through the corporate media, and therefore they don't want a guy like Bernie winning the election and ending up, or the nomination and ending up on a national debate stage and defending the poor on national television. That is not something at all the power interest want to see. So in addition to people selling because of the coronavirus, many of them are selling because they see Bernie Sanders rising in the polls and they're concerned. They're concerned for what he could mean for the stock market. And I'll tell you, and I even mentioned this recently on one of our calls, is that if Bernie Sanders does win the nomination, or if it looks like he's going to, and we'll know by Super Tuesday, because Super Tuesday is coming up right here. Well, I'll have a slide here, March 3rd. That's coming up on Tuesday. So we got Texas, where Bernie Sanders is leading. You have California. You have Oklahoma. You have Alabama. You have many of these states. Minnesota's up for grabs. And so all of these different states that are going to be voting on Tuesday, if Bernie Sanders comes out as one of the clear victors of that day, it's very possible that he could become the nominee. Now, the chance of him becoming a nominee and the Democratic National Committee even letting that happen, they already tried to block him in 2016 and they succeeded. If they do it again, I mean, they certainly could. But if it becomes clear that he is going to be the nominee, I would expect the stock market to continue to have problems and to go down, especially healthcare stocks, insurance stocks, right? Oh, these are going to be hit. They've already been hit pretty hard. So many people haven't talked about this as being a key thing. We've been talking about this for some time. The Bernie Sanders effect upon the stock market is real, and you're going to see more fear-based selling the more he rises in the polls because the rich are scared. They're very, very scared. I've talked to several of them. I talk to many different people around the country on a regular basis, many of them very wealthy people, and they are extremely scared about Bernie Sanders. Now, to me, again, for those of you who know us or you know me, I'm very apolitical when it comes to Democrat versus Republican. I don't have a dog in the fight. I look on it almost with just, sheer fascination. It just seems unbelievable that we've ended up in a place like this. But it is where we are. And nonetheless, Bernie Sanders certainly could create a big fight, and it could cause all kinds of negative types of emotions leading up to the 2020 election. And that could put a tremendous amount of volatility into the stock market. So we did a radio show, a podcast on socialism. I called it American Socialism 101. We have our radio show for those of you who are new to Follow the Money. You can find us on Spotify, Follow the Money Radio, or you can find us on our website, followthemoney.com. But we did a podcast called American Socialism 101. I encourage you to go back and listen to it, where we talk about this socialism-capitalism debate. And it's an ad nauseum debate. It seems like it's been going on for decades. We really kind of try to dissect it and help you as someone who's trying to figure out what the heck's going on here. This podcast, I think, would be very helpful to you. Okay, so let me give you a quick swing trading update. I know many of you out there are swing traders. Many of you might be position traders as well. So we've been doing daily trading ideas here at Follow the Money since 2012. Been issuing a brand new swing trading alert every single day, designed to generate between 1% and 5% within 1 to 5 days. And we release these new ideas by email and or text to all of our members each and every weekday. So right now, our current swing trading positions, I'll just show you. We currently have a position in DOG. We entered at 54.90. That's a flat position. That's the short, 1x short Dow 30 ETF. We also have a position in the short QQQ. We added that on the 21st of February. That's up about 11%. And then the SH, which is the bear S&P 500 ETF. We entered that on the 21st. It's up about 12%. So, it's really quite something when you look at the S&P 500 down 12% last week, and our position is up 12% because we bought an ETF that would go the opposite direction of the S&P. We bought an ETF that would go the opposite direction of the Nasdaq because we saw that the market was pretty frothy. And so we issued these ideas. We'll see if the Dow 30 ETF DOG, the bear ETF here, is going to move higher. We may get more selling next week, and we'll see these ETFs go higher, or we may see them pull back. We've raised our stop losses on PSQ and also SH to lock in some decent gains. But you can see here, here's SH. We entered at 23.27. We've raised our stop to 24.88, currently about 26.11 on SH. And then we have PSQ here. This is the short Nasdaq. These are ETFs that you can use that go up when the market goes down. And for many people, this is new. Like they're not familiar with this. And so if this is new to you, these are really interesting ETFs. They're inverse ETFs, and they go up when the market goes down. So this is PSQ. So these are some of the ETFs that we were holding last week that our members were alerted to last week. And we plan on continuing to try to, determine and watch and monitor this market to provide more ideas. We just entered, as I mentioned, DOG on Friday. 54.90 was the entry. And we'll see, again, if that continues higher or if it's going to pull back. Again, we could get a relief rally at the beginning of the week. Our newest idea, which we just gave out to members, is XLK. So this is for tomorrow. We have a trigger price on XLK at 89.88. If it breaks above 89.88, we're going to add it to our swing trading portfolio and probably hold it just for a short amount of time because it could be a relief rally. But this is what we call a tripwire setup. For those of you who are students, you're familiar with that. It's a pretty powerful strategy that we teach our students that can really lead to some pretty explosive profits pretty fast. Again, these are designed to provide a 1 to 5% gain within about 1 to 5 days. That's what our swing trading ideas are designed to do. So we're looking at XLK tomorrow. Could get a rally in technology. Technology continues to be the leading sector. For us, we track all of the different 11 sectors of the S&P 500 and rank them, and then provide those on our website. And technology, as of right now, is the top-ranked long-term sector. So even though it's seen a lot of selling, and even though it led some of the selling last week, it's still at the very top of the heap when it comes to overall relative strength. So XLK is an idea we have for next week. And you can see some of our recently closed swing trades. GDX, we locked in we actually had a total potential gain, I should say, of 11.6% on that trade. Yamana Gold, about a 16.8% gain. SWH Switch, about 16%. MPW, a nice medical REIT, up about 16%. So these are ideas we put out for our members. And you can see all of our track record and everything. Everything's transparent on our website. You can go to followthemoney.com/daily trade and learn more about our daily trading ideas. So let's just kind of summarize this and talk about what lies ahead. Right now, if you go to the Fed Watch tool at the CME Group, you'll discover that the target rate probability for the 18th of March meeting for the FOMC is 100%. In other words, there is a 100% chance, according to the futures market, that the Fed is going to cut rates on the 18th of March, at their meeting on the 18th in March. So a 100% chance, and not just cut rates by 50 basis points. And I think that's probably not out of the realm of reason. That might change over the next few days. We'll have to see what happens. But as of right now, the market is pricing in a 50% or 50 basis point rate cut in March. So let's talk about a few takeaways here, and then we'll open it up for questions. We're kind of at the end of the hour here. I want to get your questions and see if we can address any of the things that you're bringing this evening. But first of all, let's talk about a few takeaways. Number one, global central banks are likely to coordinate monetary policy measures if the selling continues next week. So very, very likely. We've already heard rumors that global central banks are trying to coordinate some sort of response in order to get this under control. Now, whether they'll be able to succeed at that is no one's guess, again, because cutting interest rates does nothing to open up a factory, right? Cutting interest rates does nothing to help quarantined individuals with a pandemic, right? So the Fed really doesn't have much of anything but one bullet in its gun, right? It has the same bullet over and over again. Print money, print money. When they cut rates, they're printing money. It's always the same thing. It's always printing money. And so can printing money help the situation? Well, it probably won't hurt it, right? Initially, of course, it will in the long run. But is it going to help it immediately? We'll have to see. We'll just have to see if this is going to work. And I would expect if we continue to see the pain ramp up next week, we could certainly see that. And I would also say be cautious because, again, we may see a burst of buying at the beginning of the new week. Don't forget that Tuesday is Super Tuesday. And if we see a big Bernie Sanders victory on Tuesday, I'm expecting to see a sell-off the following day on Wednesday. Again, as I've tried to stress to you, I'm not kidding to you. The rich are scared. They're very, very scared of Bernie. And so they're going to liquidate their holdings, and they're not going to hold their holdings if they think Bernie's going to win. They're going to sell. They're just going to totally sell. So I would just be very, very aware of that and not let that blindside you that there's a big effect there. I don't think that really says anything about I'm not trying to say anything about the political race either in the 2020 election by saying these things. I'm just making blanket statements. Unfortunately, some people are so highly politicized that everything that's ever said about any of these individuals cannot be interpreted in any way but being pro or against. In some people's world, you must choose Coke or you must choose Pepsi. There really is no other option. And so for the people who live in that world, it's not easy to talk objectively about Bernie Sanders and Donald Trump. But if you see that there is something more than just two options, then it becomes easier to be objective about politics. Okay, and then another takeaway here. Physical gold is likely to rally sharply if the Federal Reserve offers more easing. So again, I would watch the Fed, and when the Fed opens their mouth, I would expect gold to start responding immediately. But don't be surprised if gold continues to sag here, and maybe even sag beyond the statement of the Fed, because of these margin calls. So if the selling continues, people may not have a choice but to put selling pressure on their gold holdings to raise cash. But eventually, we'll reach a place where the net buying of gold, because of the Fed's actions, will overtake the selling. I would also encourage you to focus more on U.S. and China state actions and less upon their state-sanctioned messaging. Both countries, the United States and China, strictly control the statements that come out of their respective governments. We like to think here in the West that China, is state sanctions everything, and we like to think that we don't here in the United States, but in reality we do, just like China does. And so the United States and especially Washington is very, very controlled in its messaging, and especially on this topic, we've learned this recently that they've become extremely sensitive upon this particular topic. And So therefore, instead of listening to their flapping lips and just hearing what they're saying in the media, it would much more important, I would say to you as a savvy investor, to watch what they're doing. So pay attention to the state actions. What is China actually doing? What is the United States actually doing about the crisis? Not what are they saying about the crisis. Another takeaway here, we were mostly in cash before the worst of this sell-off, and it's not because we were geniuses. It's not well, we've been trading for a long time. Don't get us wrong, but it was kind of in the charts. It was kind of obvious. We were starting to see rising volume, selling pressure. We were certainly in that frothy zone on some of the market breadth indicators. So it appeared very clear to us that we were likely to see a pretty sharp sell-off. So we began to raise cash, not last week, but the week before. And we told our students about this. And we even got short right ahead of the weekend into last week. And, and I was just talking to somebody recently. In fact, I was talking to somebody 2 days ago, and they were asking me about how I was positioning. I was out somewhere, and somebody was asking me, how are you positioning in this environment? And I told them I'm mostly right now in cash, to be frank with you. And the person was so stunned by my answer, and he said, "What do you mean?" And he wasn't an investor. He was actually he's a scientist, and he has money in a HSA, and he also has money in a 403b. He's a professor, and he said, "What do you mean you're in cash?" And I said, "Well, I moved out of my risky assets into cash. I locked in some gains." And he said, "Well," he said, "didn't that you have like a tax bill or something? How did that work?" I said, "No, I just went to cash. I have money in an IRA, and so when I move to cash in an IRA, then it's not a taxable event, right? Because it's a tax sheltered account, tax advantaged account, not a sheltered, but a tax advantaged account." And it blew his mind. And it made me realize that so many people today, because the banks are so good at this, because the banks only make fees if you are fully into your stocks, right? If you just go to cash, if you sell out it and take a gain on something because you don't want to be in the market, because you don't want to have to be drinking Maalox, right? You don't want to deal with it. You want to move to cash. Well, you have that right. Now, nobody is telling you to move to cash, but there should be a button for you to know that you can push that, right? Most people don't even know that button exists. So if you have money in a 401k, a 403b, an IRA, and you say, "You know what? I'm not comfortable here, and I don't want to lose a tremendous amount of my retirement assets like happened in 2008 because I don't know what's going to happen," then guess what? You can go to cash. Now, again, I'm not telling you to do that because your financial advisor and you may have a plan or something in place. But the reason I say it is because I found that so many people don't know that's an option. They say, "Well, I can only be in this mutual fund, or I have to be in this mutual fund, but I don't have a cash button." Well, you can sell whatever you're in. You don't have to sit in any stock or any mutual fund. You can move to cash. And cash is certainly king at the crash, right? And so we did the same thing back in 2008. We moved to cash. Didn't want to be participating in this huge, massive sell-off. No, thank you. I'll wait for this market to finally calm down. And once it's got it all out of its system, right, and it starts to kind of form a base, and then it starts to get some more volume and it starts to curl up, all right, well, then we'll be ready to move back in this thing. But we're not chomping at the bit to go play day trader in this market this week, right? We got other things to do. And so the market is likely to be very, very wild over the next few weeks. And you don't have to be in it. You can certainly go to cash. Again, not a recommendation. I'm not making a recommendation that you do that. I'm just telling you that it's a possibility. And for those of you who weren't aware of that, it is. And so if you have a 401k plan, you can always talk to your plan administrator and just say, "Hey, I'd like to sell some of the things that I have. I want to go to cash." And if that's what you want to do, then you have the power to. You are the controller of your own money, right? You are the one who controls your own money. So don't leave it to your 401k plan administrator. Don't leave it to somebody else who doesn't have a fiduciary responsibility to you. You take care of your own money. You protect and preserve what you have. You be a wise steward. And don't feel like you have to sit through every single bear market that comes along because there's no other way to do anything. I was just going to make this comment also. I'm happy to sit on my hands until that strong buying volume level returns, right? So I'm happy to wait. I'm in no rush to jump out there and try to, see if I'm right or I'm wrong. I'm happy to sit on my hands and kind of watch here because I have a feeling this week might tell us a lot, might tell us a whole lot. Also, I think we're going to get some potential bargains in China. I'm a China bull long term. I was not surprised to see Elon Musk made the comment the other day that he expected China to be 2 to 3 times larger, its economy to be 2 or 3 times larger than the United States in the coming years. China is already a larger economy than the United States based upon GDP on a purchasing power parity PPP basis. And so, it's not surprising that China is going to continue growing. And this pullback, of course, in China is probably going to devastate some companies. It's probably going to drive many companies out of business, some companies out of business. But this could create some pretty big opportunities here. This pullback could create some really big opportunities in China, also in the United States. But particularly in China, I think, you could have some really distorted prices potentially, and it might be worth taking a look. So we'll be watching that area as well. I think the best thing here is just don't put all your eggs in one basket, right? So having some diversification. And this week, again, some people said, I am diversified. I have equities, I have gold, I have Bitcoin, and they're all going down, right? That's what we saw in 2008. And that's why it's possible, not certain, but possible that this could be much bigger than what we understand quite yet. We don't know yet. We don't know exactly where this is going to go, but this looks a lot like the beginning of what we've seen before in the past. And if it's like what we've seen in the past, it doesn't get pretty immediately. It takes some time. Okay, so let me move now into we'll take about 10 minutes here, 5 to 10 minutes, and just address your questions. We have quite a few people here this evening, and I'm grateful to have everybody tonight. And I want to now turn to your questions. And thank you for being here. Okay. Okay, let's see here. Let me go ahead. Okay, so in fact, I'm going to start by going toward the end, and then I'll kind of move backwards. So let me start there. Jim, hey Jim, how you doing, my friend? He says, if you have a position long or short, is it a good strategy to hedge with an opposing ETF? Yes, absolutely. That's one of the nice things about these ETFs like SPY and SH, where you have a 1x long and a 1x short. And sometimes, and this is the way sometimes I'll use them, but sometimes if I'm uncertain, I'll either not be in either one or I might buy both. And then what I'll do is I'll cut one loose at the open. Based upon what I see the market doing. I've done that sometimes. You can use them to hedge. You can buy, maybe you say, I think the market's going to go up, so I'm going to buy, the S&P 500, but I could be wrong, so I'm going to hedge some of that position with some SH and get, some direct opposite exposure. And I think that's a really smart strategy too. I do that quite a bit, Jim. Gabriel says, have you ever seen a 95-to-1 silver to gold ratio? It seems prime time to buy for silver. Yeah, it's been a long time since I've seen that number, and I don't even know if I've ever seen it, to be frank with you, Gabriel. It's a number that is pretty mind-numbing. It's really out of the ballpark. We have normally seen much lower numbers, but it's pretty shocking. It's really good for silver, and this recent pullback in silver, again, may not be over because fears of a global economic crisis or a global economic slowdown because of this is not going to be good for silver initially. So you might just watch silver here, but yes, I'm very attracted to silver at current levels, but also especially if they fall. But I'm also long gold and have been for some time. Justin, hey Justin, he says, I agree. He says, I'm patiently waiting on the sidelines in cash. No harm, no foul, right? There's no reason why we have to play smart guy and hop in and try to hop in front of the bus and see if we're right. This is a wild market. And if you have cash, you have dry powder, then you're in really good shape here. We may see a pretty big pullback, and now is a great time to be making an inventory of a list of stocks that maybe you wished you owned, maybe when we were watching the uptrend, and I know many stocks that I had seen, and I said, man, I wish I would have got into that stock, a year ago, but it was too late then. You don't want to chase some of these uptrends. And so, but now so many of these stocks have pulled back that now you have that opportunity. So if you've been waiting for a pullback, this is it. But at the same time, is it over, right? That's what we want to be cautious of. We're not sure if it's over yet. Gary, hey Gary. Gary says, does the gold to silver ratio really matter? And if so, why? Is there a cause and effect relationship between them? Gary, historically, it's taken much less than 95 ounces of silver to buy 1 ounce of gold. And the idea or the thinking behind that ratio is that when they get out of whack, they tend kind of a mean reversion. It tends to revert back to a mean of some kind. And so right now we have gold and silver really stretched on that ratio, and it's really in silver's favor. And so we would expect at some point to see silver rebound here. But it is a helpful ratio, Gary, but we have seen it, I would say, in recent years become a little less relevant. Certainly. So I concede on your point there a little bit because it's not as useful as it used to be, but it is nonetheless a noteworthy thing with the number we reported there. Pretty big. Okay. Don says, should we get a relief rally? I'd be interested in buying selective puts on individual stocks more likely to go down than up. What are a few opportunities that you've seen in prior similar setups that might have beneficial risk-reward profiles? If we get a relief rally, Don, and you're basically saying that you would think that relief rally might be a dead cat bounce, and so you might be interested in buying puts on the strength in the market. If that's what you're saying, that's a smart idea. And another idea, too, is if we get a real solid week this week, you could also look at potentially maybe buying some calls on some of these, maybe even volatility, or maybe even some calls on some of these short ETFs that went up so well, because there's undoubtedly going to be more negative news ahead. So we would certainly expect to see more raucous kind of trading as we move forward. But yeah, I think that's probably good. I don't know if I fully know what you're asking there, Don, about what are a few opportunities you've seen in prior similar setups. I think you're thinking right, though. If you're thinking about potentially buying puts on some stocks on the next rally whenever they go on sale, when the puts go on sale, that's probably a smart way to think about it as a speculative kind of trade. Michael is saying, is now a good time to buy gold? I think so. I mean, I personally hold a core position of my total investable assets in physical gold, and then I trade gold-related ETFs or gold mining stocks on top of that. So, a physical gold base, and then some gold trading on top of it. And personally, I think gold right here, again, I've been bullish all year long, though. And I think 2020, in fact, I told several of you at the beginning of the year, 2020, I think is going to be the year where we're going to see more volatility because of the 2020 election. And then we're also going to see gold. And I think gold certainly has a very good potential move forward this year. So I would personally say, yes, I think that. Let me see here. Jeff. Hey, Jeff. Yes, right now we have the futures open in some places. Let me see here. And we do have futures. Yeah, it looks like the futures are dropping here at the outset. We'll continue to watch. A lot of things could happen overnight, but thank you for that, Jeff. I appreciate that. Let's see here. Okay, let me see if I can get to any... Justin says, hey, Jerry, I'm currently following your swing trading ideas on paper. That's a very good idea, Justin. And that's really what they're for. They're not really designed for you to go trade personally, but they're designed more for you to see how we actually go about, identifying an opportunity and how we find the trigger price and how we go about doing all of that. But anyway, Justin says, it seems like I don't always see all of your trading ideas on the daily trade ideas. Sometimes do you do that on Twitter? And the answer is correct. So our swing trading portfolio is our daily trading idea. We put that out every single day. But then we also have our private Twitter community for all of our platinum members. And that's where I put out real-time ideas. So if I make a move in the middle of the day, that's where I'm going to put that information. Jonathan says, hey, Jonathan. He says, hi, what are your thoughts about the company Ripple and how it will affect our XRP prices, crypto? I'm a long on Ripple, Jonathan. I've been long on Ripple since 2013. When I first bought Ripple, I couldn't buy it. I bought it so early I couldn't buy it. I was like trading for like 0.2 of a penny. And I had to go online and find somebody who would give me 20 Ripple, and so that I could participate in the ecosystem. Because back then you had to have Ripple in order to buy Ripple. This is way early. I spotted that company early, Ripple, and I thought it was an amazing opportunity. So I scooped up some XRP and I started dollar cost averaging in. Since that time, I'm still very bullish on Ripple, and I still hold Ripple as a longer-term investment. I'll probably hold it for at least another 5 to 10 years, at least. But that being said, there's been a lot of competition that's risen, and Ripple, even though it offers a great technology, great protocol, and all of this, it's also centralized. There's some negatives about it, but the centralization actually might make it more attractive, I think, from an investment standpoint, considering that it needs Wall Street's acceptance, perhaps, or at least it gets it. But yeah, no, I'm long on Ripple. I like it, and I plan on holding for another 5 to 10 years. Mike says, I love your platinum level tweets. Thank you. You bet, Mike. It was great to have you. I see a lot of our students in here tonight. Great to see you guys. I'm glad you guys are watching these markets and you're aware. I know many of you, this didn't catch you off guard because you're watching, you're paying attention. And oftentimes, we've often said this, Bernard Baruch, one of the greatest traders who ever lived, and one of the best investors as well, said, you want to know the news, look at the chart. Show me the chart, I'll tell you the news. And so many times we get bogged down with all of the noise from the media. The corporate media is so loud, and it's constant propaganda and constant press release after press release. And they get you all confused and whipped up and emotional. We teach our students, look at the chart. Look at the chart, turn off the news. You're going to see it on the chart, right? The chart will tell you the news. And when something matters, you're going to see it on the chart. When something really doesn't matter, you're going to see that also on the chart. So the chart is very, very powerful for traders and investors. Elias asking about our precious metals unit, Tom Cloud. Yeah, you were trying to buy physical on Friday. Yeah, he was inundated with calls, as you can imagine, last week. So I'm sure you'll get a call back on Monday, Elias. Good question. Thank you for that. Okay, it looks like we've gone through most of these questions, the ones that I can get to this evening. Let me see if there's anything else. I hope I didn't miss anybody. Let me go back and look here, make sure I don't want to leave anybody out. Oh, Jim. I see Jim. Jim says, you may address this question, but if not, here's my question. At the start of the week, I purchased an inverse ETF, and I put a low stop loss on most of them. What I found out during the week is that I got stopped out on most of my positions. How can I protect my positions even when I put a low stop loss? Well, Jim, I mean, last week was wild, right? And so typically you don't have these kinds of wild swings like we saw last week. So I would say that last week, most people got stopped out on something. I mean, because, it was wild. But I would say in a normal setting, if we weren't talking about last week, if we were talking about any other week, then maybe we could find something. But last week, I would just say we have to kind of scrap that week as any kind of case study because it was just so unbelievably wild. And this week might be the same, Jim, which kind of builds the case. Maybe just to sit on our hands here because we know there's going to be potentially lots of volatility. And, unless we are prepared, to be exactly right on every single thing, we might end up losing money. So just use caution. I've been trading for a long time. I'm happy to sit on my hands here. I'm not chomping at the bit to go jump in the market in the morning. I want to see what's going on. I need to hear more. I have no clue what's going on, right? I mean, I just told you all the stuff about the coronavirus. I just told you all the stuff that we know. You know what ultimately is the problem is that most companies are tight-lipped. They're not talking about this. We don't know what this actually is going to mean for the overall corporate earnings. We don't know. And because we don't know, it builds a huge case to sit on the sidelines here and watch this and not to try to play the smart guy. And, if you get on Twitter and you see all these people making money, just ignore that. Turn off the noise, look at the chart, let it speak to you, let it speak what it says, and learn how to trade with that chart. And if you need coaching, we're here, followthemoney.com. We want to help you. We want to serve you. We serve people all over the world, been helping people for 10 years, have coached thousands of traders over the years, and we're happy to help you as well. If you have any questions, feel free to reach out to us, info@followthemoney.com. Go to followthemoney.com and learn more about our services. And we have a whole lot more coming up. For those of you who are Gold and Platinum members, this Tuesday we're going to be doing a private group coaching call, and I bet you we're going to have plenty to talk about there. So be ready for that on Tuesday, my friends. Thank you for the feedback. I see Terry saying, great webinar, Jerry. I've been listening to you for about a year. I just became a silver member tonight. Where do I start? Great news, Terry. That's awesome. So you just became a silver member. Welcome to you for being our newest silver member. The silver members receive our daily trading idea by email or text. So the first thing you want to do is you want to go sign up for text alerts if you want to receive those by text. You find that on the daily trade page. The next thing is you also want to go through some of our video trainings that we've provided for you. That's a great place to start. So your dashboard is just filled with tremendous information. We also have an income university, a multiple streams academy that teaches you how to create income streams, 22 different income streams you can create both now and in retirement. So there's tons of resources at your fingertips right there in the silver membership. And I hope you have an opportunity to take advantage of them. And if you want to reach out to us, we are happy. We typically offer a free 15-minute kind of onboarding session with every new member. So if you'd like to reach out to us and shoot us an email, we'd be happy to set that up, Terry. Great to have you here. I want to welcome you. Okay, my friends, we're going to bring this to a close. If you want to continue to receive videos like this, we do one every single week for all of our Gold and Platinum members. Become a member at followthemoney.com and let us help guide you. Let us help coach you in this current environment. We'll teach you how to avoid some pretty big mistakes, and we'll also teach you how to take advantage of some of the opportunities that lie ahead. God bless, my friends. Take care.